Welcome to our weekly Ask the Fund Manager series. The premise is simple. We put a fund manager on the spot and we ask them questions about current events and how these events impact on investment markets. We aim to keep it interesting and understandable and do this all in under 5 minutes. We hope you enjoy.
Last month, we discussed the juxtaposition between a V-shaped equity recovery on one hand, and then the ongoing uncertainty due to the continued conflict in the Middle East, which has reached something of a stalemate. We're now a month down the line at the end of May. It's gone extremely quickly. We're at record temperatures in London and also around record highs for multiple equity markets. To think about the three main themes driving this, I'm joined today by portfolio manager Harriet Ballard. Welcome back, Harriet.
Hi, good to see you.
Good to see you too. Okay, so what are your key themes for May?
So the first theme is really unchanged since last month. Geopolitics continue to be the main macro driver. The second theme is earnings strength against a backdrop of ongoing macro concerns. And the final theme is higher rates and inflation.
Let's start with geopolitics. Feels like the perennial theme at the moment, but the news flow is actually quietened quite a bit on Iran since the conflict reached the current stalemate. And it's still your main theme.
Yeah, even then news has slowed and tensions are still ongoing. There have obviously been some constructive talks, as well as some relatively small exchanges of fire. But crucially, the supply of oil has not returned. And for as long as oil supply is constrained, this will remain a central theme for markets. We've seen that the oil price is acting as a central link between a number of risk assets. And markets are continuing to react quickly and directly to geopolitical headlines. Outside of the US-Iran war, we've also seen conversations between the US and China, the EU and China around trade and supply chains. And we've also had political instability in the UK. So geopolitics still very much making itself a key theme.
Absolutely. And what you've described there are what could definitely be perceived as a set of headwinds for the macro environment. But if we think about equities, firstly, we've seen incredibly strong returns from global equities since the bottom of the market at the end of March. So what's driving this? And I think crucially, do asset prices actually reflect the reality of the situation?
Yes, earnings are remaining very strong, particularly in the US. However, the performance is highly concentrated in a small group of AI-driven mega caps, as well as chip makers. And these companies are driving the majority of the overall market returns. So headline indices look resilient, but underlying that, the market breadth is still quite weak. And against this very strong earnings story, equity markets have had to contend with disappointing economic data in Europe, elevated rates, geopolitical uncertainty, and tighter financial conditions.
Yeah, so let's think about that last point and think about central bank policy, which is another really big talking point at the moment. So we've been hearing about another potential inflation shock driven by energy and the AI demand. What is the outlook for inflation from your perspective, and how is that likely to be reflected over the rest of this year?
Well, the longer oil supply is constrained, the more sustained the inflation shock will be, and central banks will need to respond to this by changing this changing dynamic. You have to remember that at the beginning of the year, investors were pricing in rate cuts in some economies, and now hikes are being priced in. So the risks to inflation at the moment are definitely skewed to the upside, and the longer the oil supply shock continues, the more that central banks and investors will worry that this will lead to second round effects that sustain inflation high, even if oil prices were to decline. And central banks have reacted over the last month by becoming more hawkish and signalling the potential for further rate hikes. And markets have also been trying to assess how the new Fed chair, Kevin Warsh, will change the dynamic in terms of the Fed pricing. And then finally on this theme, as you mentioned, there's been an ongoing debate about how AI will impact the inflation outlook going forward. And I think in this instance, we need to break it down into the short-term or near-term effects, and then also the longer-term impact. Near-term, the lack of supply of data centers and chips have definitely seen prices rise and push prices higher, and that's being inflationary. Over the longer run, if productivity increases, then AI may have more disinflationary impact. But for now, it's adding fuel to the fire.
Thank you so much. And AI, once again, the theme that seems to be running through everything. So I think if we were to summarize that, equity markets have been doing brilliantly. The AI story has really eclipsed geopolitical and macro headwinds, but they're very much still in place. And the outlook for the rest of the year is still quite heavily contingent on the outcome of the conflict on the Middle East and what happens with the oil price. It feels at the moment like markets are pricing in some kind of resolution. We've had some constructive talks, but it still feels a little bit uncertain. We're going to wrap up there, but not without leaving you with a stat of the month. So if you think about the S&P 500, the US equity market, earnings growth for the first quarter of 2026 was over 25%, an astounding figure, which is more than double the average figure that we saw in the second half of 2025. Thank you so much, everyone, for listening. And we'll see you next week for another topic that has caught our eye. Thank you very much. Bye.
Thank you for listening. We hope you enjoyed this episode, and we hope you listen in again next week. Also, we love to get feedback and ideas for future episodes. You can use the link provided below to share your thoughts. Before you go, just some important information to be aware of. Unless otherwise stated, any opinions expressed are those of Aviva Investors. You should not be viewing this as an indication of any guarantee of return from an investment managed by Aviva Investors, nor as personal advice of any nature. Information contained herein has been obtained from sources believed to be reliable, but have not been independently verified by Aviva Investors and is not guaranteed to be accurate. Past performance is not a guide to the future. This material is not a recommendation to sell or purchase any investment. The value of any investment and any income from it may go up as well as down, and the investor may not get back the original amount invested. Nothing in this material, including any reference to specific securities, asset classes, and financial markets, is intended to or should be considered as advice or recommendations of any nature.